Hello, my name is Craig Weeks. I am the Senior Vice President of Trade for BAFT. It is my pleasure today to conduct this webinar entitled Updating the English Law Version of the BAFT MTLA. BAFT is the leading global forum for bringing the financial community, its solution providers, and stakeholders together to collaborate on defining best market practices to facilitate efficient delivery of trade and cash management products and services for their clients. Going back to 2014, the BAFT Trade Finance Documentation Working Group developed the MTLA, a bank-to-bank master trade loan agreement under both English and New York law, with the assistance of outside counsel to provide clear, concise, and consistent language for usage by the industry. Starting last fall, a working group finalized the updated version, now known as the 2025 MTLA. This document was designed as an industry standard for lending between financial institutions to finance or refinance particular trade transactions. More specifically, the 2025 MTLA English law version reflects changes based on current market expectations, law, and practice, including the demise of LIBOR and the impact of Brexit, as EU law no longer applies to the UK. In addition to changes in the structure of the original 2014 document, the revised version also contains provisions to streamline a trade loan request to introduce the concept of the booking office, included optional sustainability clauses that can be incorporated into the loan request, among other changes. In this webinar, we will hear from two renowned experts on this specific document, Mr. Jeffrey Wynn of the law firm of Sullivan & Worcester and Ms. Hillary Brown of the Bank of New York. Jeff is the head of Sullivan & Worcester's London office and its trade and export finance group. A leading trade finance lawyer, Jeff specializes in trade, structured trade, and commodity finance, advising major banks, non-bank financial institutions, and multilaterals on transactions in emerging markets. His expertise includes warehousing financing, collateral management, ownership structures, and receivables financing. Jeff works with industry bodies, including, of course, BAFT, ITFA, and the ICC, advising them on documentation and rules promulgated by them in trade finance. Ms. Hillary Brown specializes in trade and supply chain finance across traditional trade products at Bank of New York. With over 9 years of in-house experience at Deutsche and BNY, Hillary has an extensive background in cross-border transactions with a deep understanding of the operations behind bank-to-bank lending. Hillary supports letter of credit operations, trade distribution, and institutional lending. Our webinar today will consist of an explanatory presentation by Jeff, tag teaming with Hillary to explain the updated document, followed by Q&A. To that end, please post your questions in the question stream. I will be monitoring that stream and look forward to those questions, promoting interesting and useful discussion and knowledge sharing. Before I pass the microphone over to Jeff and Hillary, we have a polling question. Please take a look and vote. Okay. Good mix of responses there, Jeff and Hillary. I think we have our work cut out for us today. So over to the two of you. Thank you.
Craig, thank you very much. Good morning, good afternoon, good evening to everybody. Well, Craig, you summarized exactly what we were going to do. So I assume I better add a little bit of flesh to what you said on that. Hillary, please jump in, and I've got some teasers for you anyway. Just a quick look at the history. The 2014 Master Trade Loan Agreement was created, as Craig said, in 2014. It was created as a master document, but essentially, even though it was uncommitted, it had all the terms of the loan. So consequently, it was quite a long document because it was seeking to cover quite a lot in one document. Flexibility about interest, flexibility about term, and so on. One of the quick questions that everybody had asked about the master was, well, who would use it? And as Craig said, it was designed to be used between financial institutions, but that was actually not terribly clear. on that. And I suspect some of you may well have tried to use it with non-financial institutions, which creates a degree of problems. Also, a lot has happened since 2014. And so if you like, the key drivers behind any update were very much changes in law. And one magic word or phrase called LIBOR, which naturally drove the need to do some updating of the document. We also had seen limited update, although I'm very pleased to see that more than 50% of you on this call have already used the 2014 master. And I think part of our job is to explain how you might benefit from the change. So we refreshed the drafting to reflect what we felt was current market expectations, current law and practice, and to create a more up-to-date order of treatment. So I held the pen, and there was a very strong, active drafting committee from really across the globe that helped. And Hilary was one of those who was exceptionally helpful with comments, even though we may not necessarily have agreed all the time with her comments. But it was quite interesting because as we developed our discussions, we suddenly came up, if you like, with a sort of light bulb moment where we thought we could move away from this master trade loan structure into a master structure, which had, as we've described, a sort of modular structure. So the whole basis of this was that financial institutions, lender and borrower, could sign up a master which set out some of the base commercial terms that they wanted up front to agree, but then have some flexibility that they could reflect into an offer acceptance mechanism. And for those of you who are familiar with the BAFT master participation documents, it followed that sort of format. And therefore, you had a master, and then you had a specific transactional offer and acceptance. We also introduced, and I know Hilary was very much a supporter of this, the idea of a booking office, so that this is not available to, if you like, the master parties, affiliates and subsidiaries, but you had flexibility both as lender and potentially as borrower to have a booking office. So you could change the booking office in each offer and acceptance. I mean, Henry, you felt quite strongly about that. Do you want to say a bit more at this stage?
Yeah, absolutely. I'll say a bit more about that. It's because from a BNY perspective, so much of our business for trade finance is financial institutions. So we have a head office who has a trade line of credit, but that extends to their branches. So we may have a head office who is in Canada, but they have a branch in London, and they don't want their London office to have to sign a whole new master agreement. And that makes sense to us, right? So their head office has signed the master agreement. We simply just changed the booking office on the loan request to the master party London branch. And we also have BNY also has a London branch. We may not necessarily book the loan out of London, but it's at the discretion of the borrower and the lender. So, and that's true for a lot of banks across the globe, is that they would like the option of booking out of various branches where they have the ability to book loans in various currencies. And that's true for the borrower and the lender, is that they would like the option for, if they have a trade line of credit for a head office, they would like to extend that trade line of credit to their branches as well. And that's why it was very important to add that concept into the 2025 Master Trade Loan Agreement. Some other things, if you don't mind, Jeff, if I can elaborate on some things that I thought needed to be updated to this master trade loan agreement that I thought were maybe some of the reasons folks weren't using the 2014 agreement besides LIBOR. Is that okay if I elaborate on that now?
Yeah.
I think from a lender's perspective, when you look at the trade loan section of the 2014 MTLA, even though this is meant to be uncommitted facility, there was some commitment language when it was time for the lender to issue an acceptance, right? Because once the lender issued that acceptance, they had to issue the loan on the value date. In the new 2025 MTLA, there are preconditions, right? So at least once the lender issues the acceptance, there is an obligation, as long as there's no events of default on behalf of the borrower, and those preconditions are there. So it's still completely uncommitted on the part of the lender, but there is an obligation to lend on the part of the lender. So the borrower can be sure that that money is going to be sent out on the value date. So it's a bit more secure. And the language is very clear here between the borrower and the lender in the new 2025 version. And I think the language was also a little bit jumbled and not very clear what exactly happens if the terms of the initial loan request were issued, excuse me, if the terms of the loan request were rejected by the lender, what exactly happens? There were so many if-then statements in the 2014 version. And now I think we just work to make it very clear and very easy for anyone who wants to read the 2025 MTLA to make it very clear. There's a loan request that comes in. If it's not accepted by the borrower, the terms can be negotiated. A new loan request comes in, and there's an acceptance. And once there's an acceptance, there's going to be a payout on the value date. So it's just very clear what the terms are between the borrower and the lender. And I think it's a lot easier to read, and it's a lot easier to understand. It's a lot easier to interpret. And there's not a lot of ambiguity in this agreement. And I think that's helpful to everybody. And I think the terms in this agreement are fair to the borrower and the lender. It's going to be easier to negotiate. I know from a lender's perspective, it's going to be easier to negotiate with our borrowers, I think.
That was really good. That was a good hit on that last point, advice on whether to adopt the MTLA. We're going to go into a bit more detail on that because Hillary's already selling this, which is good news. On that next slide, please, Catherine. Okay, so this is, if you like, these are the headlines. That first change, the offer and acceptance mechanism for making of trade loans. What that means is, as Hillary was saying, is that instead of having, if you like, an uncommitted loan agreement, which had sort of all the terms, you've got a lot of flexibility because the trade loan comes out of a trade loan request from the borrower. And as the second point says, provisions, commercial terms can now be included within the trade loan request. That means that the master document is clean of a lot of references to multiple currencies, multiple methods of assessing interest. You can deal with that on a case-by-case basis on that. Hillary's already expounded the benefits of the booking office, but the booking office is there, both for lender and borrower, if the parties agree. So the idea is that you would sign the master up, not necessarily as your head office, but with the flexibility of being able to choose different branches. There's an annex, and I'll come on to that later, about sustainability. A lot of work is being done in relation to sustainability, and consequently, we felt it was important that the master should keep up with the possibility of having essentially a sustainable trade loan as well as any other trade loan on that. We clearly removed the references to LIBOR, and we've given you in one of the schedules a fairly similar way to the approach to the BAFT Master Participation Agreement, which is central bank rates as your sort of fallback. So if you want to keep your transaction relatively simple and flexible, you can choose the currency with its central bank rate rather than, but you're of course free to do term SOFR, term SONIA, and so on that. Next slide, let's step back and look at the key features. This is important because, as we've said, it's to be used between financial institutions for financing and or refinancing underlying trade transactions of the borrower bank. Now, that's quite important. You can flex around as to what you want to see, but this essentially is a way that a lending bank can add to its trade finance portfolio by providing finance to another bank to enable that bank to conduct trade finance transactions with its own customers. Essentially, it's a bilateral, so there's no syndication on this. Of course, sell down is possible if you want to do it by way of participation. It is designed to be unsecured, so it's very much bank to bank, designed to be uncommitted. And that's an important point, I think, for banks signing this up, wearing their lender hat, to know that having agreed the terms of this master, it is totally uncommitted at that point. So neither the lender is committed to lend nor the borrower committed to borrow. And this last bullet point that I'm going to ask Hilary to expand on, because she was very keen on this wording, the obligation to lend is in the acceptance. So you've got a master that says what will happen if the parties choose to have a lending transaction, a trade loan. The request, as would normally comes from the borrower saying, would you like to lend on this basis? But nothing happens until we get the obligation to lend in an acceptance by the lender. Hilary, over to you.
Right. As a lender, I think a lot of us can be very concerned with that commitment language, right? So we're in an uncommitted facility. We're very clear to make sure that the language we use stays uncommitted. So if there's any language in the agreement that says we have an obligation to lend, that can be concerning. But our borrowers need to know that they can count on us, right? So if they send us a trade request and we say, yes, we confirm that we're going to send you the money on the value date. So the only obligation to lend is in the Schedule 2, which is the trade loan request, which is what the borrower sends the lender, and it has all of the terms of the trade specific loan, the trade transaction details, and then the acceptance is what the lender will send back to the borrower. And it simply says, according to the details of the loan request we sent you, we accept. And there's a brackets that the lender can send back that has anything specific, if anything else needs to be added. But that's where the obligation to lend is at. It's not in the master at all. And that was very important from a lender perspective to me.
Just to interject, Jeff and Hilary, there is a question in the Q&A string that I think would be beneficial to get the answer to now, if you can. It says, can you please elaborate on what does a trade transaction mean in this agreement? How are you defining that?
Well, we're actually defining a trade transaction almost how a bank, borrower and lender want to treat the trade transaction. So what we've said essentially is however you want to describe it, because I know going from bank to bank, some banks want a very detailed explanation of where the borrowing bank's money has gone, whereas others want to be just very general, as long as they know that the on loan has been made for, if you like, trade purposes, that would be sufficient. Our concept, I think, was that there would be an underlying trade transaction or transactions. In other words, this was not simply working capital, that as the money went from lender to borrower, from borrower to its customer, that it was supporting a trade, buying and selling of goods, financing, goods in warehouse, or whatever. But you can be as descriptive, or if you like, non-descriptive as you like. And we'll come on to that when we talk a bit more about the trade loan request. But it is flexible, because that's the importance of this. Because if we made it too specific, then nobody would do it.
Right. So just to specifically answer the question, so trade loan is defined in the agreement, means a loan to be made by the lender to the borrower in accordance with the provisions of this agreement and the relevant trade loan request for which an acceptance has been provided. So going to what Jeff says, right, you can further define it in the trade loan request. But then a trade transaction means an underlying trade transaction, which is to be financed or refinanced by the borrower utilizing the proceeds of a trade loan as described in the relevant trade loan request. So, it's a little bit self-actualizing, right? But you do have to define it in the trade loan request, and that's going to be between the borrower and the lender. But when I talked about this agreement with our trade finance product owner, and I talked about the various ways, like the purpose of a trade loan itself, right? And I talked about why is the point of defining a trade loan important to a product owner in trade finance, right? Why can't it just be open-ended, right? And it just depends on it depends on what you have approval for, right? What is your product owner and the use of this agreement have approval for, or what do you have approval for this borrower? You have a trade line of credit for this specific borrower, so it has to be used for trade purposes, and trade purposes may be very specific. It may have to be a transaction between your borrower's customers' underlying trade transactions, so that may have to be underlying letters of credit between buyers and suppliers, commodity traders. So it may be very specific. So to answer that person's question, you have to think about what the use is for and what it's approved for your own bank. That's what I'm thinking about.
No, I think that's right. I mean, one of the interesting things for another webinar, no doubt, is that there's a strong feeling, I think, in the banking community that it's important that where you're lending in trade finance, that there is an underlying trade transaction with a phrase that I've often used, which is trade gets paid. So there's a strong feeling that where banks are involved in trade transaction, that if something were to go wrong, there's a greater likelihood that the underlying trade transaction will get paid back, and consequently the loan between our lender and borrower will get paid back, rather than just being unsecured or whatever.
Right.
Next slide, please. Let's take a deeper dive. I'm just making sure that we. So okay, we've talked about a master. We've talked about the concepts, but I thought it was important that let's get into a little bit of the nitty-gritty, if you like, of what's in the master itself. So the first bullet point, the idea is to save negotiating time for general commercial points. In other words, you have a master document that sets out quite a lot of the framework of the relationship between the lender bank and the borrower bank, so that you've got the boilerplate that's in there. You've got representations and warranties, undertakings, and so on, which I'll talk a little bit more about. But as the recitals say, the terms of a trade loan are agreed from time to time. So the master itself does not prescribe what the trade loan would look like. But unless you call it a trade loan and deal with it in accordance with the offer and acceptance, you don't have a loan under this master. No limitation on offices, currencies, interest rates. You can set your transactional arrangements up right from the outset. So basic conditions precedent that you want as a lender from your borrower, you can deal with that, and therefore you save time. So you're ready to go with everything you needed to get started, signatures and the like on that. And then where you have a specific transaction, you can set out what else you need. So you can add the specifics to the transaction. So again, just following on that question, sometimes you may want to make a very specific loan, shipment of goods or whatever. Sometimes you may say, look, I'm happy to finance your receivables transactions. Both of those are possible. We also reworked the clause order because quite a lot has happened since 2014. And I was looking at a comparison between the 2014 and the 2015. We've changed the clause order. We've got that, what we think is a more market acceptable clause order. We've updated sanctions wording. We've covered data protection in a generic way. If you want to add more, you can. We've put in bail-in, which a lot of you want. We've removed LIBOR for the umpteenth time on that. And we've also put in a lot of FATCA wording. If you don't need FATCA, this relatively short document gets even shorter, but it's there as an optional on that. If I move to the next slide. So representations and warranties are straightforward. You can then add additional ones. And I think, Hilary, I'm going to ask you to comment once I've done the next bit. I think we've got what you described as sort of the balance, that this is fair to the lender and not over onerous in its general terms to any borrower bank. So that goes for representations, undertakings, and events of default. We worked on this together. Is that your feeling about the whole thing? That it's a good document that you would want to sign?
I think it's quite balanced, and I think I think you could honestly use this as a mutual agreement. Like you could negotiate this with a view that I could flip this around and be either borrower or lender if I needed to.
Yes, because we didn't ask in our audience who were lenders and who were borrowers. But it was actually, this is not a two-way document, but it was actually designed not to be over onerous on either side.
Right. Right. Well, because we had borrowers and lenders represented in the working group. So we had advocates from both sides, right? And then even though I was on the working group and I was representing a lender perspective, I also negotiate a lot of trade loan agreements, right? So in terms of time to revenue, which is what my business likes us to think of, right? From the perspective of their borrowers, they don't want me spending a ton of time negotiating trade loan agreements, right? They want the trade loan agreements to be market and fair to our borrowers so that they will be easier for our borrowers to sign. So
I have two procedural questions to ask you guys just for clarity's purposes. One listener has asked about the bail-in clause. Can it be removed, relaxed, or altered? And secondly, does the trade loan, is it restricted to 1 year tenor or less?
You can remove the bail-in if you don't want it or don't need it. Tinkering with it, well, it's up to you, but it's a standard bail-in clause. So I'm not sure I would recommend wasting time negotiating it. I mean, either you need the bail-in, in which case it reflects the bail-in position. On tenor, no, you can do what you like. You can term it out on that. I mean, most, if you like, underlying trade transactions that we meet in this market are relatively short term. So you would expect them to be sort of less than a year, but it doesn't stop you having interest periods, doesn't stop you having resets. That's all available in the trade loan request. That was the idea, was that if you've got a transaction that the trade transaction is 2 years or whatever, you can deal with it. You can deal with bullet repayment. You can deal with periodic repayment. It's all there. Nothing is required to be pre-agreed when you sign the master, because that was, if you like, our view of the magic of this was that. So you, as a lender and a borrower, you can talk to each other and say, look, we don't know what we might do, but here's the framework as to how we're going to do it. And if you like, with the exception of saying, well, bail-in is never going to apply, FATCA is never going to apply, I don't need anything additional. This document as a master works. So all the square brackets, you've just got to agree a few business days or whatever, and you've got a master that sets you out, and you've got a framework of a trade loan and the trade loan request. Hilary, I'm going to back this one to you, because the trade loan request, if you like, again, as I said before, following the sort of offer and acceptance concept of the BAFT Master Participation Agreement, you've got a series of headings in the trade loan request. You can deal with them as you see fit. And the trade loan request is split, if you like, into the mechanics of what the loan will be, in other words, the amount, currency, interest, repayment, and then what else you require in relation to the specific trade transaction. Hilary, you wanted to say some more about?
Absolutely, yeah. So with respect to the tenor, Craig, what was the question before? Can you change the tenor?
Just a second.
It was bail-in.
Yeah.
Oh, bail-in. Yeah.
Can the bail-in clause be removed?
Yes. If it's not applicable to the borrower or the lender, yes, absolutely. You can change the bail-in clause, right? I agree with Jeff. Like it's a standard bail-in clause, so I wouldn't mess with it if it's needed. But if it's not applicable to the borrower or the seller, to the borrower or the lender, yes, you can remove it. With respect to the tenor, so with respect to the tenor, you can make it whatever you need it to be. But if you have a credit risk officer saying, for this specific borrower, we can never offer a trade loan longer than 367 days, right? And I want to make sure the form of our trade loan request says that, so that ops will never offer them a loan longer than 367 days. You can put that in there. You can adjust the form of your trade loan request for whatever your needs are, right? Be specific. It can be specific to the borrower, even though each trade loan can be very specific to the transaction. You can adjust the form of the loan you can adjust the form of the loan request for your master, right? And that's what your loan ops team will use every time they get a loan request from the borrower going forward forever and ever. So it can say the tenor can still be in brackets, but there can be a parenthesis saying, as long as it's under 367 days, and that way your loan ops person will know this matches the form going forward. Some other things you can think of, if you're the borrower, you may want your lender to have an automatic debit authorization on the day of each interest period that's due, or the date of maturity. Or if you're a lender, you may want to have that authorization, right? You may want to have a debit authorization added to your loan request. You may want to have a lender-specific reference number in the loan request that's also in the lender acceptance. And you may say like, oh, well, how will a reference number be assigned when I'm sending the loan request in? You should have already been negotiating the terms of this loan prior to sending in your loan request, right? Because really, when you send in your loan request, it's probably going to be, around 4 or 3 days prior to the value date of you actually needing that loan, right? So your relationship manager or your structurer and you should have already been negotiating the terms of this loan prior to you needing the loan. So I would do that, right? I would negotiate the terms of the loan prior to you sending in the loan request. And then I would send the loan request in via SWIFT to the branch of the lender that you would like to book it in, and talk about where you're going to book that loan in with the lender. And then if you're the lender, can you support the currency in the branch that you're planning on booking in, that your borrower needs? And then is there anything specific that you need in the trade loan request, right? If your borrower needs to have 30 trade transactions listed in the loan request, and you are willing to support 30 trade transactions listed in the loan request, use the annex to list those trade transactions and send them in an Excel spreadsheet or some kind of electronic file. Don't try to list all of that in your trade loan request. Just reference that file, right? The file I sent you on this date that has these trade transactions listed in it, but have all of the information from the trade loan request, and check with your trade ops person and make sure all of the information that the borrower is giving you is the information that you need to process those trade transactions. Any other questions, Craig?
There's an interesting question it's in the chat, naughty. Somebody says, given that the MTLA is on an uncommitted basis, are undertakings in event of default necessary? And this is one of my favorite sayings, is that there's nothing as committed as an uncommitted facility that is utilized. So the idea is, of course, if it's uncommitted, you're right. But once you as a lender have put the money out, you're very free, a questioner, not to bother with representations of warranties, undertakings, and events of default. But then you're on your own, mate. You sit around and watch horrible things happening, and there is nothing you can do until you get to the repayment date. So that if you like, the recommendation is that you deal with your trade loan request in the way that Hillary's talked about, but essentially you've got the protection of the master, which says if something has gone wrong on a particular trade loan, I have the right to call that loan, or indeed to call all the loans. So that's the structure for you. That's what we think the benefits. And then somebody's made me smile. How do you know that FATCA should definitely not be included? Now, I'm only an English lawyer on that. But if you keep away from a US link to the transaction, you're normally fairly safe to get rid of FATCA. But hey, Hillary, you're a US lawyer if you want to add any more. But as far as I'm concerned, if you're lending in London to an emerging market in Africa or whatever, we would tend not to put FATCA wording in there. But as I say, it's there if you want it. It's there for flexibility. You can disapply it in a trade loan, or you can apply it if you subsequently need it. This is the flexibility on that. Because as we're running on, I'm hoping that what we've demonstrated is that given the flexibility of the master, the ability to negotiate a lot of terms before you start, given how you might deal with a trade loan, we would hope that we've convinced you we've achieved our purposes on that. Catherine, next slide.
And yeah, we have Jeff and Hillary. We have 4 questions in the queue, so I'll hold them till we get to the Q&A.
Okay. Let me spend just a few minutes on that. The sustainability provisions, will they become standard? I mean, that's quite interesting because we think, because this is BAFT's wording, that it's a very good self-contained annex that you can incorporate if you want to make a loan that is for sustainability purposes. You get a sustainable loan, you get representations, warranties, undertakings, and defaults in relation to it on that. Will that become standard when you can sort of smile depending on where you sit and who believes in sustainability or not, which government believes in sustainability or not? And I'm not going to enter into the political realm on that. We think that the current document is a very good response to the wider market trends. If we are wrong, you can always supplement the master, but you can deal with it going forward in the next trade loan. So you can reflect things. I saw somebody did ask a question about technology integration. In fact, Hillary said a magic word because she said Swift. We had envisaged that you would sign the master, but you can equally, as far as English law is concerned, and this is an English law document, you can even sign the master digitally, in other words, electronic signatures. And you can certainly evidence a trade loan through whatever medium you want, electronic or otherwise on that. That's the magic of the flexibility. Are there further refinements? Well, let's wait and see, because the idea is that this is today flexible as best as we can foresee, but we would hope, based on all of that, that we've achieved something that you, the audience, and your counterparties can work with right now, going forward for if you like, the foreseeable, whatever the foreseeable might mean. Those were my thoughts.
Okay, so just let me start whacking away at some of these questions. Does the 2025 MTLA incorporate provisions for digital trade documentation to align with reforms like the UK Electronic Trade Document Acts of 2023? And related to that, are there restrictions on conducting these transactions digitally via a trade finance platform?
No.
That's it. It can work whichever way you want it. I mean, did we draft it with the ETDA or Melita in mind? No, we didn't, because there was no need to. Remembering that, so the English Trade Documents Act concentrates on electronic promissory notes and bills of exchange. You can, for example, if you want to, evidence the trade loan with a promissory note, with a bill of exchange, absolutely. And certainly, I would be surprised if we didn't put these on platforms. Henry, would you put this on? Do you have a platform? And would you put the master or trade loans on your platform?
Would we put the actual loans on the platform? I don't know the answer to that. I'd have to check with the product owner.
Okay. There's no reason why you couldn't. Yeah.
Another question, can we extend a trade loan for tenors more than the maturity of the underlying asset? And if so, under what conditions?
You can. It's whatever you want. I mean, conceptually, the idea would be to match maturity of your trade loan with the underlying trade transaction. But since, as a lender, you're not taking security over the underlying trade transaction, yes, you can if you choose to do so. but remembering at that point that what you're then left with is an unsecured loan that arguably might no longer be a trade loan. That's it.
Yeah. So the example that I could think of is if you just have a rolling amount of trade transactions, right? So you have a series of trade transactions that are maturing, right? But you have renewing transactions all the time, right? You have documentary LCs that are maturing every 90 days, but they're continuing to roll on, right? And they're being sent to us all the time. So, but in those cases, I believe we do have the trade loans. Tenors are still 364 days. They just roll over, right? So they're still meant to be short-term tenors that roll over.
Okay, the next question is, will the legal opinion on the MTLA be updated and issued? Done and dusted, I believe.
It's done and dusted. The English law legal opinion on the MTLA is available.
Yep, it's on the BAFT website. The use of authenticated Swift message to relay legal documents like the MTLA, how feasible is this in the MTLA? Must it be signed in wet ink?
So it's the MTLA itself is too long, right? You can't send that via Swift. What I'm saying is you could send the trade loan request via Swift. You could send the acceptance via Swift. The loan agreement itself the master agreement itself is too long, but you could send that. You could wet ink sign it and send it PDF, and send that via any authenticated electronic messaging system you have, or you could e-sign it and send it via Adobe Sign or whatever you use, or you could wet ink sign it and just send originals around. Whatever you are permitted to do at your bank is what you can do.
But don't try and put it into capital letters and put it on Swift. That it was absolutely not to be a Swift document.
Just taking one of the questions that did come in by email before we started, just asking Jeff to expand a little bit on Annex 1, the optional sustainability clause, some background on that and what the thought process around adding it and what kind of take up you've seen in this and other documents that you've been working on that have had sustainability language.
Well, this is I didn't write the sustainability wording. That was the BAFT drafting. The sustainability wording looked pretty good. How much uptake there will be, well, that's an interesting point because I don't know. If a client asks me to draft a sustainability loan, if it's a lending bank, it may well have its own wording. This is good template wording on that. What percentage of loans in trade are made on a sustainability basis? I don't know the answer. I fear less than you might expect, because trade loans is a product. This is a global product. It should not, with all due respect to those who work on the sustainability wording, it should not be constrained by saying this loan has to be for sustainability purposes. And I've spent a lot of my work is in emerging markets. And I think trying to impose on some emerging markets the Western view, if you like, of sustainability would have been bad for this document. So it's an option. There is absolutely no requirement to make a loan, a trade loan, if you like, a sustainable trade loan.
Hillary, anything to add on that?
I agree with Jeff. I think we have to be careful there.
Two more questions have come in. Can trade loans be concluded while the underlying letter of credit has already expired?
same point. It depends on what you want. I mean, the answer is yes, theoretically, because if you tie repayment of your trade loan to the letter of credit, then no, it would be a breach. But if you have a trade loan that can be rolled over, you can do that. That really is, that's the flexibility. There's nothing in the master that stops any of this happening, but you just have to tailor your trade loan request dealing with repayment, interest, rollover, and so on.
Okay.
I think Hillary would probably say in her shop, you would tie them. You would most of the time expect to tie the trade loan closely to the underlying transaction.
Okay. We have a bunch more questions that just come in. What is the difference between the ITFA MRPA and the BAFT MRPA?
I mean, this is getting used interchangeably. BAFT is responsible for the Master Risk Participation Agreements, funded and unfunded, which is the 2018 document, English Law 2019, New York Law, which we updated to reflect the demise of LIBOR. ITFA has a surety master. So in other words, an unfunded document specifically designed for unfunded that does not cover funding. They're similar in their construct, but they're multiple choice for you.
This one maybe to Hillary, talking about the booking office. Can a booking office in one geography draw a trade loan backed by trade assets of another office of the same bank in another geography?
Well, yeah, I mean, yes, it's possible, right? But it has to be mutually agreed upon between the borrower and the lender, right? So the commodity flows don't necessarily need to touch the region of the borrower, but the lender's credit risk officer may want them to, right? Because as Jeff said, trade gets paid. So if they're not necessarily touching the region of the borrower, then there may be an argument that it's not necessarily a bona fide trade transaction. But if it's a structured trade or if it's a commodity trade, but if it's in a region of a branch of a head office and there is a nexus between an exporter and an importer, there could be a connection. So yeah, I just say discuss it, right? Discuss it and we'll see if we can make it happen.
Jeff, anything to add from your perspective?
No, I mean, you can do whatever you want to do. So this is no, that was the idea. This is the flexibility.
Yeah.
Particularly on the lender side, you can give your borrower bank as much flexibility or not as you want, because underlying trade transaction is. Remember, there's no security. So we're not trying to create some other than trade gets paid.
I'm going to have that tattooed on my head. So 3 more questions have come in. Does the MTLA mandate the list of documents that need to be taken for a trade transaction?
No.
So it doesn't mandate it, right? So there's a list of line items on the loan request, right? With respect to what's needed, right? I can give you a quick rundown. Description of goods, country of origin of goods, shipment date or expected shipment date, transshipment ports, name of vessel, carrier, shipment from, shipment to, port of loading, port of discharge, place of receipt, place of delivery, transport document issuer, amount, issuing, advising, confirming, nominated bank, reimbursing bank, Incoterms, additional details. So these are just some ideas of items that are needed depending on the trade transaction, the instrument. When I ran these by our trade operations manager, he said, "This is great. This is a very robust list. We don't necessarily need all of these items. And some of our borrowers won't necessarily have all of these items to give to us." So as Jeff mentioned, everything is negotiable, right, between the borrower and the lender. But there has to be communication between the borrower and the lender, right? If you have a lender who says, look, I know this is BAFT's form of agreement, and there's a slash here, and the slash seems to mean that you have name of vessel / carrier, but we need the name of the vessel and the carrier so that we can run it through our systematic screening process. It just is what it is, right? That's just their policy. Their sanctions are strict, and unfortunately, there's no leverage in terms of negotiating sanctions policy screening with respect to your lender. But if you have a borrower and the borrower is saying, I don't have this information, I can't provide this to you in the trade loan request, and it's pre-shipment information, that makes sense. So if you're a lender, you need to be like, okay, that makes sense. Or if you don't know it because you're a lawyer and you're saying, that doesn't make sense to me, check with your trade ops manager, right? And the trade ops manager will say, yeah, they wouldn't have that information up front. They can't provide that to us at this point. They wouldn't have that information because it's pre-shipment information. It's post-shipment information. Or if the borrower says, I can never provide you that information. They're a Latin American bank and they don't collect the information, or they collect it, they run it, but they don't save it and they can't provide it to a bank later. There may be some mitigators they can provide. Like they might be able to provide an additional rep and warranty in the loan request that says, yes, we run this information when we receive it through our systematic screening. So there's some mitigators that can be provided.
Okay.
Yeah.
Yeah, we're coming up to the top of the hour. We have 3 questions in the queue, so we're going to do a little speed dating here.
Great.
For reps and warranty clauses, what ongoing monitoring is expected or required under the MTLA? And if the reps are discovered to be false, what enforcement or default mechanisms are available versus a main facility document?
Well, if you like, the master, once a trade loan is made, operates as a facility document. So the representations and warranties are repeated as you've agreed. If there's a breach, it may well be an event of default. You have a right to demand a trade loan or all trade loans back. So, as I said, this is uncommitted. Once you make a trade loan, you're into a committed facility where you have the benefit of what's in the trade loan request plus what's in the master.
Okay. Are you, Hillary, anything to add to that quickly?
No.
Okay. Next, can a bank use this as a risk mitigation tool per Basel III?
Why would it? This is a borrower lending relationship. If you want to,
A risk no, it's not. It wouldn't be a risk mitigation tool, right? A risk mitigation tool is more like if we couldn't get a clean line from the borrower would have to post, have to post the collateral.
yeah.
All right. I think we have time for 2 more. The BAFT document is subject to English law. If we do have a transaction with an FI in a non-English jurisdiction, do you foresee potential legal hurdles imposed by the law of the non-English jurisdiction in the event of dispute?
That's
Well,
where
the
we have
answer
the
is
arbitration clause.
yeah. So you've got the option of arbitration. You've got submission to English courts. That's a local law question. And that, in fact, one of the advantages of the master is that you can deal with that particular question up front in your master in that relationship. And then you've dealt with it for all trade loans made between those jurisdictions.
Okay. We are out of time. It's been wonderful having you talk to us. There are a couple of questions that are in the queue. I'm going to do a screenshot on them, and maybe we can make sure we can get an answer to those folks separately. I believe we have another poll question, Catherine. Nope, apparently not. Okay. All right. Oh, here it is. Yep, there it is. Do you have a better understanding of the MTLA now?
I thought we were going to ask a second question, like, would you use it? I want to find the 3% who said they
Yeah.
don't.
Yeah. We need to go back to school. Thank you very much, everybody. This has been great. I'd like to thank both Jeff and Hillary for their willingness to share their knowledge and expertise with our industry. And I thank all of you for joining this webinar. I hope it's been interesting, useful, learning experience for everybody. So thank you all. And yes, this has been recorded and it will be available. Thank you.
Thank
Thanks
you.
a
Have a
lot.
great
Thank you,
day.
guys.
Bye.